Welcome back. It has been a volatile month for the markets, to say the least. Our next guest says recession risks are rising. Let's welcome in Lenore, Elle, Hawkins, Calit Advisors partner. And Lenore, thank you for joining us here today. Always good to see you. I'm reading your notes, and I like what you're talking about because it's a little bit contrarian. You're not seeing the current situation that we're in like some of the other periods where we've had bear markets and avoided recession, because when we had that in 1987, 2001, 2016, things were pretty good because we bounced back a little bit more quickly in the markets than we would have otherwise. Can you break this down for us?
So, well, first off, when we look at a midterm election year, those are typically pretty bad years. But this year has been utterly incredible. We've just had the worst first 100 trading days going back to 1952 when we started having 5-day trading weeks. The only year that was worse than this was 1970, and I think we remember that wasn't exactly a good year. And this has also been the worst start on record for both the NASDAQ going back to 72 and the Russell going back to 79. So the market is telling us that something's not so great. And if we look forward from what does that usually mean, if we look at like the 10 worst starts to the year, tends to have a much weaker than normal the rest of the year. And the really concerning thing is over the past 60 years, the S&P 500 has never dropped 18% over a 5-month period without a recessionary bear market following. And while, obviously no two bear markets are alike, right now we are just 100 days short of the average number of days it takes for the S&P 500 to actually fall down to that threshold 20% decline. So we're right there. I mean, there's plenty of time for this to happen.
Lenore, hey, it's Julie here. We always hear,
Hi, Julie.
Although I haven't heard it as much lately, the economy is not the market is not the economy. So, how convinced are you that the market is correct in predicting a recession this time around?
Right. Well, there's this old saying that not all bear markets precede recessions, but all recessions are preceded by bear markets. And if we look at history of the 14 bear markets that we've seen post-World War II, 8 of them were actually preceded by bear markets. And if we are headed into an actual recession, that does mean that the market's going to get hit a bit harder. Bear markets that precede recessions tend to be about 2.25 times longer and about 25% steeper, so more painful than those that don't precede recessions. Now, what's also got me a little worried is if you look at the NASDAQ's performance this year, it has been doing what we normally see before a recession. The NASDAQ composite has lost at least 1% for at least 6 consecutive weeks, only 4 times. And every one of those times occurred with either a month before or 2 months in a recession. So that's telling us the market's saying there's definitely things to be worried about.
And I want to ask you about the bond market, and specifically looking inside the 10-year, we have break-evens, and we also have the real yield. The real yield just turned positive. I think it's notable because people had said that we're in a new norm here. It's fine to have negative real yields, and they're just going to be that way, maybe forever, new regime. Well, they're positive again. And meanwhile, break-evens, the inflation expectations part, those have been falling pretty quickly here for a little bit. And maybe that's part of what the market is repricing right now. How are you viewing the bond market and its effects on other markets like equities?
Right. Well, I think what's really interesting to see is that the bond market, we had yields, particularly the 10-year. That's, I think, the key one to watch. That 10-year had spiked up above 3% and was starting to push towards where this long-term trend where we've seen that we've had lower lows and higher highs year after year after year, pretty much trending down since the 70s. And we were getting ready to kind of push through that. And then it failed, and that kind of came along with the dollar strength sort of reversing. And now we're seeing that 10-year yield starting to come down, which I think that's telling you also that these growth expectations are coming down, and also that the inflationary pressures may be turning a corner. We heard a lot to support that in the past couple of weeks from the retailers in particular, who are talking about inventory buildups. I mean, Walmart's got the biggest inventory buildup it's had in like 2 decades. Target's got the same thing. Abercrombie and Fitch, their inventory is up like 45% year over year. When you've got these big inventory buildups, how are you going to get rid of that? We're going to get rid of that by cutting prices. So that's really good news for the consumer.
So, Lenore, put all this together for us, if you will, and tell us what you're telling clients to do.
Be careful. Take your time. Be excited though, because what this means is that we're going to have some really great buying opportunities, the kind of buying opportunities we have not had in a long time. The market has been really tough for the past couple of years, and what it did during the pandemic was just nuts. And that was because of this massive amount of liquidity that came in. It was very difficult to predict that, because who would have thought you would lock down the world and the stock market would skyrocket? Now we're kind of paying for that because it really didn't make that much sense. But going forward, we're going to start getting some things that are much more reasonably priced, and that's going to be some great news.
Lenore, good to see you. Lenore Hawkins, Calit Advisors partner. Appreciate it.